Hi friends, welcome to Dhiksoochi. I am Dr. Sabitha. Today we are going to learn capital structure theories. This topic is extension or continuation of earlier videos. Those are on capital structure and capital structure decisions. In this video we are going to study the theories. So first let us define what exactly the capital structure theories are. That is the relationship between the leverage, cost of capital and the value of the firm is going to be discussed. So the relationship studied among these three are defined as or known as capital structure theories. Okay. So before going in detail of these theories, let us see what are the assumptions of capital structure. Right. So let us see this. First, the assumptions are there are only two sources of funds. What are those two? One is equity and one is debt. Yes, these two were discussed in the previous slide, right? Previous videos. Yes, so there are only two sources of funds. One is equity and the other one is debt. Now, the total assets, whatever is given, that the investment is not going to be changed. Whatever the assets it can be. How much you are investing on it. Maybe you are investing 20 and 30% or 50-80%, whatever it is. So that investment decision is not going to be changed, because if it changes, automatically the relationship between capital and value of the firm changes, right? So the assuming that there is no change in the investment decisions and there are no retained earnings, in the sense whatever the dividends, whatever the earnings per share is there, that is going to be paid in terms of the dividend. No retained earnings, right? So that is the third assumption. Let us continue the assumptions in further slide. Those are: the risk complexion is constant. Okay, so whatever the risk you are assuming, that is constant. It is not going to affect either raising of the fund through debt or equity, right? So there are other assumptions. Let us see what are those. Okay, so the operating profits, whatever you are expecting the operating profits every year, those are constant. Those are not changing, right? So that only can define the capital structure theories. Now there are no corporate taxes, because if you calculate tax again, the retained earnings or dividends are going to be changed, and automatically your value of the firm is also going to be affected. So let us assume that there are no corporate taxes. These are the assumptions for under capital structure theories. Clear? I hope you are clear. Now the investors have same kind of expected EBIT. There is no change in their earnings also. Okay, so earnings same, no corporate tax, no operating profits, no change in the risk, no change in investment decisions. There are no retained earnings, right? Yes. Now let us see what are the capital structure theories are. There are four capital structure theories. Net income approach, that defined as NI approach, and net operating income approach, that is NOI. Then Modigliani Miller approach, that is MM theory, and traditional approach, it is generally we name it as traditional approach. These are the four theories. Now let us study what are these four theories are. First let me explain you these NI and NOI together, then we can talk about the remaining two, Modigliani Miller and traditional approach. Yes. First, the net income approach and net operating income approach, right? So left side I have mentioned the particulars, and first I have disclosed the net income approach, and the third column is net operating income approach. Let us see the first one, that is proposed by, it defines, and there are assumptions. So those were mentioned under particulars. Let us see the net income approach. Net income approach and net operating income approach also suggested, proposed by Mr. David Durant. Okay, David Durant. Both are same. Both were proposed by the same person. Maybe studied in different views, then both have mentioned in different names, that is net income approach and net operating income approach. Right? Okay. Now, what does it define? When come for define, here we can see that the firm can increase its value. How the firm can increase its value? That by increasing the proportion of debt. Means they can, if at all they lower the overall cost of capital, or else if the firm wants to increase its value, then it has to increase the proportion of debt in the capital structure. Got it? So value has to be increased in the sense value of the debt also has to be increased. This is what NI approach is. Right? Now let us see what the assumptions of NI approach. First one is KE and KD are constant. No change in KE and KD. Then what is going to be changed? Of course, the KO is not going to be changed, because we are going to increase or decreasing the cost of capital. That's the reason. So KO is not going to be changed. But your assumption is KE and KD remain constant. Now the same assumption, the related assumption, that is KD is less than KE. Means KD lies over here and KE lies over here, and K naught differs. So let us assume this is KE and this is KD. Then KO is going to differ based on the other assumptions. Right? So let us see the third assumption of net income approach. What is a net income approach? The corporate income does not exist. There is no corporate income at all. Only those incomes, what net income of the company is going to be considered. Right? Now let us see the net operating income approach. How it is going to differentiate from net income approach by adding this operating word. Okay. So what it's saying, any change in leverage will not lead to any change in the total value. So here what it's saying, debt has to be increased. But what it is saying, no, that is not going to be change the value of the firm. It means that it is independent of the degree of leverage. It is independent. It is not dependent. Isn't it? So whatever the relation is discussed over here is not going to be proved as per net operating income. Right? So now let us see the assumptions under net operating income. One is KO and KD remain constant. See here in the previous K net income, equity. Here it is cost of capital. Then what is going to change? Yes, of course, the KE is going to be changed. Right? Yes. Here the assumption is, the second assumption under net operating income approach is use of more and more debt is going to increase the cost of equity, not the value of the firm. This is what the major difference between net income approach and net operating approach. Right? And addition, there is no tax. Of course, this is a common assumption for capital structure theories, which was the last point under capital structure theory assumptions. Right? So based on this, let us see them on graphical representation. So this is what the NOI approach, NOI, net operating income approach. You remember, KE is going to change. Yes, this is KE is going to change. It is increasing, right? But what is happening to K0 and KD? Those are constant, right? As the degree of leverage is increasing, cost of equity is going to be changed, but remaining two are constant. What is net income approach? We said KD and KE are constant and KD is less than KE. But KO is going to change. Right? So this is what the net income approach and net operating approach. I hope I am clear with these two. Right? So this is net income approach and this is net operating income approach. Now let us continue for further theories. Then the Modigliani Miller approach, that is MM approach. MM approach. What it is? Who defined? Of course, the Modigliani Miller has proposed this. On his name, it is named after the same person, Modigliani Miller, as Modigliani Miller approach. Now, first, we can say that it supports NOI approach. What is NOI approach? Is independent. The leverage, the value of the firm is independent. Yes. Next, the independence of this cost of capital of the degree of leverage at any level, whatever the debt equity ratio can be. Debt equity ratio can be 3:1 or 2:2 or 1:4, whatever it can be. This is independent of its own. What is the independence of its own? Value of the firm is independent of its own. Clear? Now, the third point under Modigliani Miller is it provides behavioral justification. Behavioral. Because generally the cost of capital or the value of the firm is going to change based on the debt and equity, no? But it says that it is a behavioral justification. It is not giving any proof for it. Of course, the proof is discussed under dividend decisions, but it is a different concept over there. Now, let us see the assumptions of Modigliani Miller approach. First is the markets are perfect, means every information, the complete information is available to all the investors at free of cost. Means they are not going to raise any fund for sharing the information from the public. Right? So the capital markets are perfect. Now the securities are infinitely divisible. There is no limit for number of securities. Infinitely divisible. Right? One can buy one can buy two, one can buy infinite. No, that depends how the securities are going to be performed or occupied in the market. Then all the investors are having the same expectation of their earnings. It is not that one can earn more or one can earn less. It depends on how much you are investing, how much you are securing. That's it. But the probability of expectation, see, if market is giving 10% return, the 10% return is given to all the investors. It is not that 10% to party A and 2% to party B, something like that. There is no variation at all. Let us continue with further assumptions. That is, again, there is no corporate income tax, which is common for all capital structure theories. Right? Now, further assumptions under Modigliani Miller is the personal leverage and corporate leverage are perfect substitutes. Means if an individual feels it's a leverage, then corporate leverage is going to be applied for. Right? So the next is the dividend payout ratio is 100%. The dividend payout ratio, in the sense they are not going to retain anything with them. This was already discussed in the previous videos. That is, earnings per share may be paid in terms of the dividend, and some portion, some part of it will be kept it as retained earnings. And we discussed as a part of assumptions under capital structure theories, there are no retained earnings. So the 100% is dividend payout. Nothing is going to be kept with it. But there is a small argument related to this approach, that is the Modigliani Miller approach. What is that? Means it purely discuss about the arbitraging process. What is that? Arbitraging process. What is this arbitraging process means if there are two firms in the market, the investors generally will buy the share of the undervalued firm and sell the share of overvalued firm. So we are buying higher, buying lower and selling higher. It's what the arbitraging process is. This is what the major argument against Modigliani Miller approach. Hope I am clear. Now let us see the graphical representation of it. As per this we were discussing it, right? So V is constant, independent, cost of capital alternate obviously it is also going to be constant. Clear? Because there are only two sources now, debt and equity, so that has to manage this cost of capital, value of the firm, right? So on x-axis it is a degree of leverage for all the three assumptions and cost of capital on the y-axis. Clear? Yes. Now let us discuss the fourth approach, that is traditional approach. What does this traditional approach talks about? It is intermediate approach, in the sense it is midway between NI and NOI approaches. That is what it is called, intermediate approach. Of course you might have understood, little part is NI and further part is NOI, right? So what it is going to say, the value of the firm increases with increase of the leverage. This is NI approach, but up to a certain limit. NI, beyond this limit, will increase its weighted average capital also, and hence the value of the firm will decline. This is NOI approach. Okay? So it is what it's saying, increases. When value increasing, debt also increases. After that, at a certain point of period, this may be constant, maybe this may be decline, right? So that is what it is going to called as intermediary approach, traditional approach. If you see the same thing in the graphical representation, this is what. Okay, so this is what actually the degree of leverage anyway you have taken on the right x-axis, right? Then what is the previous one? KE is going to be increased. This is what NI approach. NOI, both are constant. From here it is C. This is what. So if you see here, it is going to suggest both the ways, and it is traditional approach. There is no change. This is NI and this is NOI. Clear? This is what the traditional approach is. Before concluding, let us see a small problem related to these theories. Okay, so there is an example. It's a operating income. Sometimes operating income also called as EBIT. Then there is a cost of debt. KD is 10%. Outstanding debt is B, 2 lakhs, and K naught, cost of capital, is 12.5%. Then what would be the total value of the firm and equity capitalization? So equity capitalization denoted by KE, value of the firm is capital V, right? Now let us see how this can be solved. So if you see the solution, first let us take the formula for it, that is value of equity capitalization. So KE is equal to EBIT minus interest. I means interest, right? This was discussed in the previous videos, divided by market value of equity, that is S. Anyway you have B, if you calculate V, then automatically you will get S. Now let us see the solution for it. EBIT is given. If you see the numerator, this is EBIT minus I know. So EBIT is 5 lakhs, right? Then interest. What is the interest? Here interest is, debt is 2 lakhs and cost of debt is 10%. So 2 lakhs into 10%, that is 0.1, is equal to 20,000. Right? So EBIT minus interest, you got it. Now market value of the equity. How do you get it? S is equal to V minus B. But here we have only P, that is 2 lakhs. Then how to calculate V? V is equal to EBIT by K naught. You have EBIT and you have cost of capital. Now divide them, you get 50,000 divided by 12.5%, that is 0.125. This also can be written as 0.125. Then the value is 4 lakhs. Right? Now you got V, you got B. So obviously you can calculate S now. S is equal to V minus B. Then you are substituting in cost of equity, that is cost of equity. If you substitute this formula, which formula you are applying here? EBIT minus interest. So EBIT is 50,000, interest is 20,000 divided by S is equal to V 4 lakhs minus B 2 lakhs. So finally how much you are going to get it? That is 0.15%. Other 15%. This also can say that 15%. So cost of debt is 10%. Right? This is 12.5%. This is just average of these two, right? Of course. Isn't it? Yes. That is how you can solve the problems related to capital structure theories or capital structure decisions. Right? So with this I would like to conclude this video, friends, and we discussed 4, that is NI approach, NOI approach, Modigliani Miller approach and traditional approach. Right? So we'll meet you again with the dividend decisions in the next video. Till then, take care. Bye bye.